how municipal bonds, tax-exempt bonds, create income tax. You ready? But they're tax-free, Josh. There's no income tax. Oh, yes, there are, my friends. Yes, there are. Yes, there will be for sure. You're crazy now. All right, so if you know where I'm going with this, my friends, give me a thumbs up. Give me a thumbs up right now if you know where I'm going with this. If you don't, that's fine. Watch the video, and at the end of the video, if you're like, oh, yeah, I get it, or you did get it, you just weren't quite sure, give me a thumbs up then. The thumbs up helps me with the YouTube algo, so I need it. So the algo is the algorithm. That's what us tech guys use. We say algo to show how keen we are on technology. Crazy. All right, so what we're going to show you here, we got Matt single. All right, so Matt's my man. He's single. That's why he's Matt single. He's got a net worth of $1.15 million. We have him with his profile. We'll show you what his net worth consists of. It consists of $1 million in a taxable municipal bond account, $1 million. Now, it matters not what the cash value or the account value of this is. It matters what the interest or the income off it is. That's all that matters. He's got a house for $150,000. That's it. That's all he's got. All right. That's all he's got. He's got $1 million in a municipal bond fund. He's got a home. That's it. But we don't care about the actual net value of the account. We care about the income he needs from it. And so his goals are to have $2,000 a month in retirement expenses to live on, and then $5,000 a year in healthcare costs. So essentially, he just needs, what's that? Roughly $30,000 a year to live on. Does that make sense? All right, so far so good, and he's going to get it from his municipal bond. We don't have him getting any Social Security right now, none whatsoever. So if you go to retirement and we go to cash flows, hold on just a second. Yeah, we go to cash flows. I don't care about the probability of success right now because it's irrelevant. I'm just showing you his taxes. We go to cash flows, and you can see where's his income flows coming because he's got nothing. He got no Social Security. He's got nothing. He's just taking it from interest off his portfolio. And he's taking it from selling a little bit for a small capital gain, but it's not. I mean, I don't even think there's going to be any capital gain. But he's selling part of the principal, and he's taking interest. And as you can see, no tax payment whatsoever. But if we go to the accounts, we'll see his account is going down a little bit because he's spending it more than what he's earning for sure. So we can see withdrawals from accounts. He's taking a little bit out each year. Well, not a little bit, all of it out each year to pay his bills. All right, so $32,000, $33,000. And if we go to invested asset, we can see what his return is. It's 2%. He's getting 2% per year on his tax-exempt bonds. So that's what I'm saying. It matters not what this balance is. It matters what this is for what we're trying to accomplish here. I mean, if you're getting 4% a year on tax-exempt municipal bonds, you could have $500,000. I don't care what the balance is. I just care what your net is in terms of tax-exempt interest. All right, so if we go to the tax, we can see here, there is no tax. Why is there no tax? Because he has all tax-exempt interest. And if we go to I think it's right here to see the tax code. Did it click on it? Oops, we want to go here. Oops, bear with me just a second. We want to go here to see the tax. Yeah, here we go. We have $20,000 of tax-exempt interest. A tiny amount of capital gain because when he sells something for a gain, but at the end of the day, there's not enough to overcome his standard deduction. So $20,000 of taxable interest. It goes down to his taxable income, which is line 11, which is zero. Line 11 taxable income, which means his total tax on line 15 is zero. So you can see he owes no tax. If we fast forward to 2040, he still owes no tax. In this case, it looks like his portfolio has gone down quite a bit. It won't matter because I'm going to show you what will matter here in just a second. So here he had $7,665 of tax-exempt interest, but he's got $18,000 of total income simply because he had to sell some capital gain principal, which will give him a capital gain, but it doesn't matter. It just does not matter. You can see real quick right here. If we go back to the tax, retirement here, blink. There we go. Go back to the cash flows, and we go to right here. There is no tax. Never. You see that right there? No tax. All right. So now let's go to profile. We're going to cancel out of that. And instead, what we're going to do is we're going to exclude this from the plan. All right. And what we're going to do instead is we're going to say instead of an income from his portfolio, his municipal bonds, we're going to have income from Social Security instead. And we're going to say he will, based on full retirement age, and he'll get $3,000 a month. Does that make sense? So we're going to say $3,000 a month based on full retirement age, And now we're going to go to retirement. All right. And if that's all the income he has, it'll be tax-free as well. Now, he's run out of money, but his Social Security is more than adequate for his expenses. And if we go to taxes here, you see, again, no taxes whatsoever. And if we go to the details, we see, let's go to next year here, 2022. We got him taken at 70. All right, so let's actually have him taken at early as possible. We're going to go down here. We're going to take Social Security as early as possible. There we go. All right, cool. So now we got 100% probability of success simply because his Social Security is more than adequate for his income. If we go to taxes here, he has no taxes because Social Security is tax-free. So Social Security is tax-free. Municipal bonds are tax-free. And if we go to his details here, it's $36,000 of Social Security income. If we go to line 11, which is taxable, or line 10, which is his taxable income line, you see a 0. And if we go down to line 15, it says total tax is 0. So he owes no taxes. We go to 2030. And the same thing is going to be applicable here. He has a little bit of interest because he's reinvesting what he's not spending on Social Security in tax-exempt interest, but it won't matter. $46,000 of Social Security benefits. None of it's taxable. So, again, we go to line 15, no taxes, and we can keep going. Well, I tell you what, it'd be even more effective to show you here. We'll go to cash flows. And what you'll see is his Social Security, his expenses, his taxes are 0. Does that make sense? So he's got no taxes. Social Security is tax-free. Municipal bonds are tax-free. But let's combine them, shall we? So if we combine the two, will they be tax-free? Huh? What do you think, my friends? Will they be tax-free? Watch this. You ready? So we're including the $20,000 of income he'll get tax-free from municipal bonds. And let's take a gander, shall we? Oh, the tax code, I love you. It keeps guys like me occupied, and I enjoy looking at this. So not only, he's not running out of money, I don't care, but right now I'm looking at the taxes here. So we're going to go to cash flows, and we're Whoa, wait a second. $134 in taxes, $461 in taxes, $599 taxes. What? $2,000. How could that possibly be? What is going on here? Why are we getting taxes? That's crazy. Where are the taxes coming from? Well, let's take a look at a 1040, shall we? So in this case, he's got $20,000 of taxable interest. That's 2% tax-free. $36,000 of Social Security. His provisional income is $7,900. Or his taxes, AGI is $7,900 right there, because you take $20,000 tax exempt plus the $18,000 here, and he's single, and then you figure out the provisional income, how much of that Social Security is subject to taxation. $7,900. That's what's subject to taxation. So $7,900 of his Social Security is subject to tax, which is below the standard deduction. So he owes no tax, right? But let's fast forward 10 years. Now it's 2030. Oops, there we go. $25,000 of tax-exempt interest plus $46,000 of Social Security means now that $24,000 of his Social Security is subject to taxation. More than half. All right, $24,000 is subject to taxation. Now he's got total income of $33,000. All right, so he's got taxable interest of total tax adjusted gross income of $33,000. He did have to, and he's going to have a standard deduction here of $9,857 because this is after the Trump tax bill. Plus, he's going to have some interest here as well, his personal exemptions. So he had taxable income of $18,193, $195. So he has taxes due $1,000. So isn't that interesting? So before, we can go to cash flows. All right, so let's go to cash flows. And we'll see, all right, where's this income? How? Why has he got to pay tax on it? We're going to show you income inflows. And it's all from Social Security, right there, all from Social Security. And then we're going to go back over here. And we're going to show you, we're going to go to accounts. And we're going to go to withdrawals from accounts. And it's not, actually, it should be net cash flows. Is that what it is? Net cash flows. So basically what just a second. I want to go to ending balance required, net cash flow, ending balance. Here we go. So what's happened? Oh, this is what I want to do right here, portfolio return. So his portfolio return, you see he's getting 2% a year on whatever balance this is right here. All right, but he's got net cash flows of $4,000. That's all tax-free, but some of it is going to be a capital gain in this regard. It won't be much, but some of it will. But still, at the end of the day, he's got net cash flows above and beyond what his portfolio returns are. Even that doesn't matter. Even if he didn't have net cash flows, the facts are what used to be tax-free is now subject to tax. And that's what's, and if we just, again, look at the tax form, we see it was before tax-free on Social Security, previously tax-free on municipal bonds, is no longer tax-free simply because of the provisional income rules. We go to 2026. You see he's got this amount of his Social Security is subject to taxation. That amount of his Social Security is subject to tax, which means some of that will be subject to income tax, where before it was not. So if you have Social Security by itself and tax-exempt municipal bonds by itself, they're both tax-free. You combine them together, though, you're going to have to pay a tax without question. Most likely. It depends on what your brackets are and whatnot. Pretty interesting, huh? So keep that in the back of your mind as you're investigating tax-exempt bonds. I think you'll find there is something to be desired for sure. All right, we'll see you next time.